Hi everyone, welcome. It's great to see you. It is 1 p.m. We just got the market bell close on what's today? Tuesday? Uh, Tuesday, I think. Wednesday, April 17th. Let's see how the market did. We actually, the last couple days have been not as bearish, but as the week started out, but still bearish. We are still headed downwards, and we've been getting some really crazy, choppy market movement throughout the day. So the markets have been having trouble sticking to one direction. So except for this morning, we did get very directional and come downward. So we started out up and then traded downwards. That's similar to what we saw on Monday. So this week especially, and when we're looking like there's downward pressure, it is not great or exciting news necessarily for us to open up, because that's a lot more potential for us to keep on trading downwards. It gives us a little bit more comfort actually to see it open down, because the natural market force at over 70% is to trade towards the previous day close. So if we actually open lower, there's a higher chance that we can trade higher and potentially go up for the day. So today we opened higher, we traded down. The same thing that happened on Monday. Yesterday, you can see that we also actually traded a little bit, or opened a tiny bit higher, mostly flat. But yesterday we chopped around for most of the day. Today we opened higher, traded lower, and tried to recover. We tried to make this effort midday to go back up, but unfortunately the bulls were not able to hang on to it, and we traded down and then sideways into the close. And there's the same story on all the major indices. So there is definitely bearish sentiment in the market, or at least the bulls are a little too nervous to come in and really defend levels. But for now, temporarily, just for a couple of days only, we are expecting a little bit of a bounce, because this was major movement. Remember that even though on a measured move basis, on a absolute and a percentage basis, this was not a huge downward movement, but on a day range basis, it was pretty significant. It was either the largest or the second largest downward day that we've had this entire time, that we started moving upwards since October. So on the medium term, yes, we are looking bearish. Now that we've come to this nice horizontal support level that we drew a few days ago, we could get a bounce from here, or we could come and bounce off of that MA90. It would be pretty bearish of this market for it to keep on trending downwards. And now what has happened? We have gotten our roughly 5% downward move. We're just a tad bit shy from a 5% move, but we have touched support. If we go all the way down to that MA90, then we will be at 5% or a little bit over 5%. So that would be a reasonable place for us to bounce. And since we are now down below this previous uptrend line and below this rectangle, we did identify the current trend as just turning bearish on Monday. And this would be either here or that MA90 would be an appropriate place for us to pause. We don't expect a straight line down to 10% for a correction, but this would be a good place for it to pause if it was going to head down to a 10% correction, or it could bounce and recover from here and start going bullish. Now, based on what we're seeing right now, it seems like there is going to be a higher probability that this is going to actually form into a full downward market or a 10% correction. So it would be nothing to freak out about, just like this one right here, where we waved up and then we came down about 11%. But where did we pause first? We paused at 5.8%, and then we came back up, and then we came back down, and we paused at 8.5%. Then we came up and we came back down, and then we bounced at roughly 11%. So this didn't happen in a straight line. And this one didn't, let me see. This one didn't happen in a straight line. So we don't expect a straight line downwards on that 10% correction. So really close to where we are, potentially a little bit lower at that MA90. We should expect at least a pause, and if not a bounce upwards, before we start heading back down towards that 10% correction. And again, that 10% correction at this point in time, based on all the market forces that we're looking at, seems like the more likely case than simply bouncing from where we are and making new highs. So why do we say that? Let's just take a look at everything. And why does it look like that we're going to pause or bounce? Let's take a look at everything else that is happening in the market. So let's look at the DXY, dollar. Dollar had this nice huge run upwards. Now it's pulling back a little bit, so that will relieve a little bit of pressure on the stock market. And then let's look at our bonds. Our bonds broke way down after Powell kind of gave a reality check to the bond markets, and they started to wake up a little bit and face reality that, hey, we're probably not going to get a rate cut anytime soon. Still possible that we might get one this year, but it's not the three that has been priced into the market for several months now. I think pretty much since the beginning of the year. The beginning of the year, the market had a wake-up call where we went from 6 expected by the market to just 3, and now they're finally waking up to the possibility of just 1. And 1 is a reasonable, or 0, 1 or 0 in 2024 is a reasonable expectation. Let's take a look at our FedWatch tool and see what is being priced into the market currently for June. So it's looking at 16.8%, 16.8%. So we have a much more realistic viewpoint of how many of the probability of a rate cut in June. Now, did we wake up and carry that forward for all the months for the rest of this year, or are we just kicking the can down to the next month and the next month? So let's take a look at that. July. Okay, so it looks like for whatever reason, we don't think June that much anymore, but the market is still kind of enthusiastic for July. And I don't think so. Based on all of the data that we've been seeing, it's just really not the case. And the numbers are manipulated, unfortunately, and it's obvious. And the government doesn't even do that much, or the Bureau of Labor and Statistics doesn't even do that much to hide the fact that they manipulate the numbers so that the CPI or the inflation doesn't look that bad. I'll have to find a chart for you guys. So one of the most obvious ways that they manipulate the data is they change the basket of goods that they index off of. So previously, one of the items in the basket of goods was steak. And now they use ground beef instead of steak. They replace ground steak with ground beef. And so when they measure that basket of goods, it's not the same basket of goods anymore. It's cheaper products. So it looks like the price didn't really move up that high. But the scary thing is, even though they changed that basket of goods, the prices are still up. So prices are actually moving at quite a clip. And I'll have to find a study or an organization that calculates it the same way that it used to be calculated in the 80s and in the 90s and in the 2000s, just so you can compare apples to apples. The CPI prints that we have now is not the same as what we used to, and they sneak around with what they price in there. That's just one of the ways that they manipulate that inflation data. One other way that we know that inflation data is manipulated is when you compare across countries. There's no really good reason why the inflation data should not be relatively similar across countries once you account for currency movements. So if the US dollar versus the Canadian dollar is, just say it didn't change. What if it's $1 to whatever the exchange rate is right now for the Canadian dollar, and just say it was the exact same last year? Well, if that's the case, then our inflation rates should be pretty much the same as well. They shouldn't be very different because on the market, in the world market, the price of each commodity is roughly the same. You don't have a lot of inefficiencies in the commodities. Otherwise, they wouldn't be called commodities. They'd be called specialties, or they'd be called exotics, or they would be called delicacies, not commodities. Commodities are common; they're all over the place, and they have very consistent pricing across the world. So that change in inflation, unless one nation changes the way that they calculate it, or they're somehow otherwise manipulating the data and the other country isn't doing the same, the inflation rates should be relatively the same, or they should move at relatively the same rates. And in this past inflation data, we had the US saying, oh, we only moved up a tiny bit. We're up at 3.5% this month. And we had Canada print like almost 4%. So we're a little bit off here. So
interest rate
We,
sensitive.
we lost your sound, Kane.
Interesting. Thank you. I think I lost. Can you still hear me? Okay, just not as clearly.
Yes, we can hear you.
Okay, thank you. Yeah, I think my microphone is not working, not operating. So I will have to look at that later. I apologize. So thank you for letting me know that. So over here, let's go back. The bond market is waking up. A lot of industries require planning ahead. For example, housing requires planning ahead. For the real estate market, construction requires a couple of years of planning, and they do their planning based on the interest rate and projections of interest rates. So when you start signaling and you start telling certain industries that, hey, we're going to start lowering rates, we're going to lower rates for sure. Then you have Biden telling them, we're for sure going to get rate cuts this year. And then they don't happen. That messes up their plans. And they've already invested a lot of dollars into certain projects. And that's going to start hurting their earnings if the interest rates are wildly different than what the original projections are. And we already went from 6 rate cuts down to 3 rate cuts down to now it's looking more like 1 rate cut or 0 rate cuts in this year. And so that's going to mess up the industries that are interest rate sensitive and require a lot of time to plan. So that's going to be a longer term negative force in the market. So that's going to prevent certain sectors from being able to go up. So even if we have a market rally, you're probably not going to see it in every single sector because some of these sectors are now starting to get really hurt by these interest rates. It could be the financials are actually being helped by it because if they're holding bonds on their balance sheets, then that actually makes their bonds more valuable for now. But once we get cuts, then they can start getting hurt again. And we just started financials in the first round of are at the beginning of this earnings reporting season. And they've been reporting really good earnings, but unfortunately, because of the market environment we're in, they haven't necessarily been doing amazing. So we had JP Morgan, for example, report really great earnings and really great future projections, but it's still moving downwards. We have Citi reported the same thing happened to them. Bank of America reported actually on par and good revenues, and they're down also. So this market is kind of broad-based and it's taking everyone down. But like I said, we are entering an area of support. So if we look at our CPC, we are currently at 0.88. So that's not an extreme. And then let's take a look at VIX. And what is really good news about our VIX is that we reached a high over here. We haven't been able to go back up today, even though we are down further than we were on Monday or Tuesday. The VIX is coming down, and the high was not near the high of the last couple of days. So the VIX is calming down a little bit, and that should help us reach either a flat consolidation period or a bounce in the next couple of days. So our expectation is that we can probably pause, if not bounce, from the current level or slightly below it off of that MA90. And then that'll give us a breather to get out of our positions that are long, that haven't been able to close in the past couple of days, and then reposition ourselves for the next move, which is likely, based on what we're seeing right here in the S&P 500. If we do bounce, or if we hit that MA90 and bounce, then we're probably going to come back and touch the EMA 8, 50, or 20. They'll all be very similar levels by then, although the EMA will probably be lower than the other two. So we could reach a peak right there, maybe slightly higher, and then right now, for now, the higher probability event, probably about 65% at the moment, is a continued movement downwards for a correction. So we don't have to be in a rush. We don't have to freak out and just buy a bunch of shorts right now. We can probably safely wait for us to bounce back up a little bit before moving downwards. This movement downwards so far, it hasn't given us a bounce. So we can't really completely call the downtrend yet, because we would need a bounce up that would certainly be a lower low than what we've experienced before. But we need to see how high it bounces in order for us to know if we get a lower high. But the chances of us getting a same high would mean that we're going all the way back to the all-time highs, and that's just not very likely. So right now, we're very confident in calling this the beginning of a new downtrend, but we'll see how long it lasts. It does look like it will last at least a little bit longer, down to that get our full 10% correction. And then from there, we can decide, is this going to turn into a bear market, or is it going to be a correction and it'll bounce back up? Right now, there's no real reason for us to believe in a bear market or a true bearish, a bear market, but because the economic data is still very strong. There's no reason for us to believe that that is going to happen. And some of that will depend on the earnings that are coming up. I wouldn't really say that it's going to be dependent on geopolitical risk. That type of news, like I've said in the last couple of weeks, is very temporary. It does not last long term. So it would not, if there is a bear market that happens, it would not be a causal effect because of war or anything like that, unless it's a really terrible extended war. So it would just be I wouldn't call it a coincidence, but any correlation that we draw between geopolitical events and the market movement at this point, they would just be, they would not be causal. They would not have any causality associated with them. They would just have correlation. So they were pretty much independent of each other right now at this point. So what we want to do then is say, okay, well, if we're going to wait for a little bit of a bounce, as that's the higher probability event at this moment in time, then any longs that we have in our portfolios, as long as they're in the right sectors, should benefit from that bounce. And so we don't need to panic about any long positions that are down a little bit or are losing money at the moment. We have a little bit of breathing space to wait for them to come up before we exit them. So we don't have to dump and panic sell. If we come down tomorrow, well, then we check out that MA90. So again, that would be normal movement, and we would still expect a bounce from there. So we still wouldn't panic sell. So we have time, and we need to be patient and just wait for the market to tell us, are we going to bounce here and have the ability to get into a new position? And if not, then the hedges that we have in place should protect us. They should at least not allow us to not suffer a huge devastating loss. So what we want to do is in our portfolios, we want to check our hedges carefully, see if they still have enough protection in them. If not, we can add to our hedges, but we don't have to panic sell out of our positions, and we can just wait for them to rise and get out of them. The only reason why you might not wait for this to bounce is if you need the buying power in order to get into a more advantageous position. So right now, everything is moving normally in an orderly fashion. If this was not a panic move, then certainly today's action is not a panic move either. So let's take a look at our sectors and see what happens today. So again, I'll have them open. So let's take a look at momentum in each sector first, and then we can look at our sector scan. So let's take a look. Actually, let's look at the 50-day moving average of the S&P. If you recall, a few weeks ago, we were talking about how this was an extreme level and that we would expect us to move down to the 30 or 20 level, because every time we come up near this 90% level, we come down. Get to 90% level, we come down. 90% level, and they take us a little bit. We may have a little bit of a bounce, but then we come down. And then over here, we come down. Over here, we come down. So we were expecting this downward movement to happen. We did get that little bit of a bounce, but we were talking about how, well, let's not get too excited because we are expecting it to come down. So we've come down at this point. Have we come down enough? Well, technically, yes. If we see all of the historical points, we have now matched what the most frequent downward movement is. Can we come down to 20? Can we come down to maybe 15? Yes, absolutely. We have a few historical examples of that as well. So our analysis from before was very good. My personal particular execution on the hedge for the last couple of days or the last week or so was not the best, unfortunately. So even though we had the vision, we had the analysis, and we knew to expect it upcoming, my execution wasn't perfect. But for now, we're in an okay position. We do have hedges in place, and so we're doing all right. So this could bounce at any moment in time, which would be associated with a bounce at this horizontal or MA90 back up to that MA50, if we get to the MA50, then does that necessarily mean that we're above 50% on the number of stocks above their 50% average line? It just depends on the market cap of the stocks when we in the S&P 500. What it will tell us is that about half of the market cap in the S&P 500 is above or below the MA50. Half above and half below. But this is not weighted. This is not weighted. So it's possible that by the time we hit the MA50, we're below 50. If the ones that are above 50 are the large cap stocks, or the ones that are more heavily weighted in the index. Or if we're above 50, that means it's the smaller ones, the ones with smaller market cap are the ones that made it above their MA50. So when we arrive at that MA50 line, we will want to take a look at this, because that will give us an indication of which stocks are doing better. If it's the smaller ones, then it's probably going to be more temporary, because if the large cap stocks can't get above their MA50, then it's going to be very difficult for us to sustain an upward movement unless the large cap stocks eventually get above their MA50 as well. So what we want to see is that when we hit that MA50, we would want to be around that 40 to 50 area. If we start to see 60 to 70 or more, then we know that something's wrong with the picture and that we could come crashing right back down. So we'll see what happens when we get there. That's just something that we want to keep our eye on. If we look at the MA200 on the S&P 500, we do still have 66% of stocks above their MA50. However, you can see that it's on its way down. It's on a downward slope. This is not a super extreme level that we came down from, but there weren't that many times where we have hit this level, this 82%. Yes, it would be a lot more extreme and we'd be a lot more comfortable saying that it's going to come down if we were at this 94. But at this 80, 83 level, you can see that there's not that many times where we made it that high either. So when we do make it up to this 83, 84, we do have a tendency to slowly move down. This is an MA200, so it could take several weeks or several months for us to actually get down to this 50 or 40 level. And maybe we don't actually make it all the way, or we just not too far below 50 because of that weighted thing that we just talked about. So what that means to us is that when we correct, we could just touch that MA200, or we could stay a little bit above it. And because of the market cap, if the large cap stocks are the ones that stay above the MA200, and the less heavily weighted stocks are below the MA200, then that gives us the situation where on the MA200 chart right here, we have less than 50% above their MA200, but the SPY itself is still at or above the MA200. Okay, so that's what it would look like, and that's what we would expect. So that we could come down and touch this MA40 or MA30, since we are still on this downslope and we did not move that far from this peak right here. We're only at 66%. Then that is another reason for us to believe that in the medium term, we will get that correction down to that 10% level. So temporarily, in the next few days, or maybe this week, maybe the beginning half of next week, we bounce back up to that MA50, EMA20 level, maybe just to the EMA8. And then at that point in time, at least what we're seeing right now at this moment is looking more likely that we will come back down and test that 10% level, or MA200 or MA150 by the time we get down here, we'll see if these catch up to the price action. It just depends on how quickly we get there. Because these moving averages, these long moving averages take time for them to adjust, even if we have a large movement downwards. So we'll see. It just depends on how quickly we make it down to this horizontal support. So that's the picture that we're looking at. Now that we have our expectation of how the market is going to move, we can make our plan. So our higher probability plan, our plan for the highest probability path is that we are going to wait for this to recover up to that EMA 8, maybe the MA 50 or EMA 20. Once we get there, we should start positioning ourselves, our portfolio, to the downside, to bearish direction. And we should expect to be able to hang on to that or continuing to rotate into these bearish positions until we are most likely going to bounce somewhere along the way again, and then move all the way down to that 10% correction. That's the highest probability path that we're looking at right now. Now, investing and trading should always be a plan. You shouldn't always only look at the highest probability event, because what if we don't get that highest probability event? It is possible, and it does happen, where the lower probability event does happen. So what if we continue straight down? Well, that's why we have our hedges in place. So again, we want to examine our hedge to see if it has enough protection power in our portfolio in the lower probability event that we continue downwards, straight downwards. What if we get stuck here and we chop sideways? And then who knows, either it goes up or goes down. It doesn't really matter. Just for in the next week or two, we just chop sideways. Well, then what happens? Your hedge isn't doing anything for you. You're losing value on the hedge. Your positions are not doing anything for you. So you're losing time value on your positions. So that would be the worst scenario for a options portfolio, for a single options portfolio, as if we just chop sideways. And if that does happen, or it does appear that it starts to happen, then we would start flattening out our portfolio, start getting rid of positions, start going into cash, and wait and see if we move upwards or we move downwards. Or when we're consolidating here, does it then become the higher probability event that we move upwards or that we move downwards? So far from what we're seeing, because of all the forces that we just went over, right now the answer would be, even if we consolidate, we would still expect that 10% correction. However, all of the things that we looked at, that could change. If this chops sideways long enough, all of those things could change and the answer could change. So we don't want to get ahead of ourselves in that particular situation. We just know that if we start chopping sideways, we need to flatten out our position so we don't get in that pipeline. So now we have a plan for the highest probability path, we have a plan for the lower probability path, and we have a plan for our sideways path, which in our case, in our particular case, is the worst case scenario for our portfolio. So let's finally look at our sectors and just see if there's anything that held up better than the rest for today. Utilities did very, very well. Staples did very well. Financials are doing okay. XLB, basic materials, doing okay. And then communications fell, but not that much. That's kind of interesting. And same with defense. Healthcare. Everything else was kind of down. Energy's down a little, not a huge amount. So interesting that utilities and staples, so two of our most defensive sectors, are doing well. So that bodes well in terms of at least money is staying inside the stock market it didn't leave the stock market completely and go somewhere else like Bitcoin or gold or currencies or somewhere else, money markets, something like that. So let's take a quick look at XLU and XLP. Oh, nice bounce. Nice bounce off of the MA200 in this case, all the way up in a single day, all the way up to the EMA 8. It did touch that EMA 20 as well. So tomorrow is going to be very important for XLU to see if it can get above the two EMAs right here. XLP. How much was that move, XLU? 2.09%. Very strong today. XLP. XLP up 0.37% and looking like it came to retest that EMA 8. So this is going to be very important to see if it can get above that EMA 8. If it can, then it still has the EMA 20 and still the MA 50 in the way. So I'd probably avoid XLP for now. I'd be focused on potentially looking at longs in XLU, but only if it can break above the 20, and then we can get a confirmation bar after that. So we need to be a little bit patient for XLU as well. So our plan, just to review, is to wait for a bounce, that we are expecting that bounce. And then once we get to these levels right here, we'll start positioning our portfolio to the downside. Any questions? Anything you want me to go over before we end for today? Okay, all good. So overall, everything is orderly. There's nothing panicky about this. This is to be expected. It's all within expectations, I should say. And as long as we can create our plan and execute well on our plan, we'll do very, very well in this downward movement as well. So we had a little bit of a stumble, or I had a little bit of a stumble right at the very beginning, but we should be able to recover from that, no problem. All right, guys, I will see you tomorrow morning. It will be a little bit tight in terms of my schedule, but I make it the live pre-market session tomorrow, and then I can most likely do the live post-market session as well. So have a wonderful rest of your day, and I will see you tomorrow morning.